Hello and welcome to the latest news update on Canary News.
The Chinese government is urging electric vehicle manufacturers like BYD and Geely to significantly increase their purchases from local auto chip makers, part of an effort to reduce dependence on Western imports and bolster China's domestic semiconductor industry. According to sources familiar with the matter, the Ministry of Industry and Information Technology has instructed car makers to ramp up their procurement of Chinese chips this year to expedite the adoption of domestically produced semiconductors. While a previous informal target aimed for automakers to source 1/5 of their chips locally by 2025, the ministry has grown discontent with the slow progress, prompting direct orders for firms to avoid foreign semiconductors whenever possible. This directive puts pressure on overseas chip companies to manufacture their products through local foundries such as Huahong Semiconductor. In a recent tender, a foreign bidder failed to secure a contract despite offering a significantly lower price compared to the eventual winner, reflecting the ministry's push for indigenous chip sourcing. These developments underscore Beijing's intensified efforts to strengthen its own tech sector in response to U.S. sanctions and restrictions on Chinese chip development. The directive has implications for European chip makers supplying Chinese EV firms, with shares of companies like Infineon and STMicroelectronics falling in early European trading. Many Chinese automakers rely on a variety of components, including power management chips and microcontrollers, with some utilizing NVIDIA processors to coordinate functions in their vehicles. The government's focus on supporting a domestic chip industry aligns with its broader strategy to enhance technological self-reliance and maintain geopolitical advantage. Furthermore, Beijing may be preparing for potential restrictions in the auto sector, as U.S. officials investigate data and cybersecurity risks associated with internet-connected cars from China. This mandate favoring Chinese chips could lead to further tensions between the U.S. and China as Washington intensifies its containment efforts. At the recent two-sessions meeting of lawmakers, Beijing reiterated its commitment to reducing reliance on American dominance in key sectors, signaling ongoing efforts to bolster domestic capabilities in semiconductor manufacturing and other critical areas. The Chinese government has pledged substantial investments in chip development and research, positioning local companies to compete more aggressively with their foreign counterparts. While U.S. tariffs and trade measures have impacted China's chip-making ambitions, the country's focus on older generation chips has led to rapid expansion in semiconductor production. Chinese firms are projected to build numerous fabrication plants in the coming years, further solidifying China's position in the global semiconductor landscape.
Before we continue, please remember to smash the like button and subscribe to our channel.
In other macroeconomy news, recent data on inflation and unemployment filings are giving Federal Reserve officials pause on cutting interest rates, despite signs of a slowdown in consumer spending. Reports released on Thursday revealed that prices paid by U.S. producers exceeded expectations in February, while fewer individuals applied for and received jobless benefits than previously reported. This follows earlier data indicating a brisk pace of underlying consumer price increases last month. Despite some weakness in consumer spending at the start of the year, the strength in inflation and labor data reinforces the Fed's stance to await further progress before adjusting borrowing costs. With a dual mandate to maintain price stability and maximum employment, the Fed is expected to maintain rates unchanged at next week's meeting. Chris Lowe and Mark Streiber of FHN Financial highlighted that the Fed's response to new inflationary pressures amid slower economic growth would likely prolong the current pause on rate adjustments. While inflation had been receding over the past year, recent consumer and producer price index readings suggest a halt or potential reversal in this trend. Key components such as used car and clothing prices increased last month, contributing to higher inflation readings. Economists forecast a strong core personal consumption expenditures price index for February, indicating continued inflationary pressures. Despite this, some economists have adjusted their expectations for rate cuts, with forecasts pushing potential reductions further into the year. However, the retail sales report suggests a cooling economy, providing no immediate impetus for the Fed to rush its next move in rates. Bitcoin continued its decline from its recent record high amid growing concerns over whether the surge in cryptocurrencies signals excessive speculation in global markets. The leading digital asset fell by as much as 7.2% on Friday, reaching a low of $67,865. Just a day earlier, the token had reached a new all-time peak of nearly $73,798. Both the increase in Bitcoin's value this year and a measure of the top 100 tokens, including Ether, BNB, and Solana, have moderated to less than 60%. The recent rallies in global stocks, bonds, and crypto have been fueled by expectations of looser monetary policy from the Federal Reserve. However, investors are now re-evaluating these assumptions in light of persistent inflationary pressures in the U.S. Bank of America Corporation chief investment strategist Michael Hartnett recently suggested in a Bloomberg television interview that markets are displaying signs of a bubble, citing the record-setting surge in the technology sector's magnificent seventh stocks and the all-time highs in crypto. This assessment contributes to an ongoing debate on Wall Street regarding the vulnerability of many markets to a potential downturn. Supporters of Bitcoin argue that approximately $12 billion of net inflows into dedicated U.S. exchange-traded funds since their introduction on January 11 provide fundamental support, along with an upcoming reduction in the token's supply growth. However, Sylvia Tu, head of token partnerships and research at crypto exchange Bullish, noted a cooling in net ETF inflows to around $133 million on Thursday, suggesting buyer exhaustion could trigger the Bitcoin sell-off. Worries over the Fed's efforts to control inflation were further fueled by a report showing a significant increase in U.S. producer prices. Bitcoin's decline coincided with signs of increased caution in the derivatives market, which has recently been a focal point for bullish sentiment. Data from CoinGlass indicates that $668 million worth of bullish crypto positions were liquidated in the past 24 hours, the most in about 2 weeks. Additionally, the funding rate for positions in Bitcoin perpetual futures, which are popular among speculators due to their lack of set expiry, decreased according to CryptoQuant figures.
That is all the time we have for today. Tune in again tomorrow for the latest news update. Remember to like and share our videos. Also, please remember to subscribe to our channel. This will allow our videos to reach a wider audience. Thank you for watching.